In this video, we're going to construct an accounts receivable foreign exchange money market hedge, and we'll compare that with the cash flows for a traditional forward market hedge. We're told in this problem that we are going to collect 200 million yen in 3 months. We're told that the US annual interest rate is 8%, the Japanese interest rate is 6%, the current spot exchange rate is 106 yen per dollar, and the forward rate is 103 yen per dollar. So in constructing our money market hedge, our first step is to find out the US dollar's present value of that yen receivable. So step one will be to calculate the present value of that yen receivable by discounting back the 200 million yen at a 6% annual interest rate for 3 months. And again, that's the Japanese interest rate. We would be converting that to US dollars using the spot rate of 106 yen per dollar. So that would be worth 1,858,909 US dollars today. So for our hedge, we will be trying to lock in that time zero cash flow of $158 million. So what are we going to do? Our first step is going to be to borrow the 1,197 million yen in Japan, and that was simply the present value of that yen receivable. We will convert that to dollars in the spot market, and these are the steps we did or looked at in step one, which gives us the 1,858,909 US dollars that we wanted at time zero. Of course, at time one, we will collect the yen receivable, and we will use that to repay our yen loan, and our time zero cash flow is our 1.8 million US dollars. Our time one cash flow is zero, and we've constructed an effective money market hedge. For our forward market hedge, we have the same Japanese yen receivable of 200 million yen in 3 months. We need to find the present value of that in US dollar terms today. But instead of converting it at the spot rate, we will convert it at the forward rate, and our forward rate was 103 yen per dollar. So the value of US dollars, or the amount of US dollars we'll receive in 3 months, is 1,941,000 US dollars. We need to find the present value of that by discounting it back at 8% interest for 3 months, and we find the present value of that is $1,903,674 today. So that's how much money we want to lock in at time zero. And how do we do that? Best way to lock that money in today is we're simply going to borrow that $1,903,000 in the US at that 8% annual interest rate. All right, let's take a look at our cash flows then at time one. At time one, we're going to collect that 200 million yen. Recall we had entered into a forward market agreement where we were going to be exchanging that at a forward rate of 103 yen per dollar. So we will use that 200 million yen cash outflow to receive 1,941,000 US dollars. Of course, that is the exact amount we owe on our loan in the US, and we can sum things up and find our times one cash flows are zero, and our time zero cash flows are the $1,900,000 that we locked in using this forward market hedge. When we compare this with our money market hedge, which provided us cash flows at time zero of 1.8 million, clearly the 1.9 million forward market hedge is the preferable way to go. Last question will be, at what exchange rate would we be indifferent between the two? Well, since we're converting from yen to dollars, the lower this forward rate is, the better off we are, and we're already better off using the forward market. So this rate could actually be a little bit higher. How do we calculate that rate? Well, we will be indifferent if the forward rate makes the $1,858,000 money market hedge equivalent to 200 million yen. And again, keep in mind the 1 million $858,000 cash flow happens today. The yen happens in 3 months. So we need to find the future value of that US dollar amount and use that then to solve for our forward rate. And we find a forward rate of 105.48 yen per dollar. At that exchange rate, we would be indifferent. And if we had used that as our exchange rate up here, we can see that the cash flows for these hedges are identical at a rate lower than 105.48. So again, say at 105, we would prefer the forward market hedge. At a rate higher than that 105.548, so in other words, say 105.60, we would prefer the money market hedge. Let's try that one more time. We would prefer the money market hedge because it provides a higher cash flow.